Okay, hello everybody. Welcome to Crane Atlanta Mentorship. And in this video, we're going to do another review of velocity banking. If you learn these concepts, it's very possible that you could be debt free much faster than the people that you know. And what's funny is that every time I explain these concepts to the people that I know, friends, family, people I can see face to face in real life, they just kind of stare at me and they're not interested. They're not curious. They're like, "What are you talking about?" And a line of credit, what's that? And they just kind of, whatever. But I kind of know they're drowning, right? You ever have that experience before? And that might possibly happen to you, where you're confident, oh, I'm going to be debt free soon, and then you know that the people they could be helped by this, but they want to act like, oh, if I act like I need help, then that makes me look weak. Hmm, might be happening to you. Hopefully, it doesn't, but that happens to me a lot. In fact, what's funny is I'm from the state of California, right? And every time I go to California, I went there last year, and I'll explain to my friends like, "Hey, velocity banking." Look at all these people who watched on YouTube, what I teach in velocity banking about being debt free, pay off your mortgage, blah 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 blah, and not a single person was interested. But when I look at the YouTube analytics, California is the number one state that watches this channel, right? Most watch time, most views. And I know it's a big state, right? So it's possible that the people from California who watch this, or maybe are just not from Southern California. Maybe they're from San Francisco, which I've never been to, or from, Central California, right? But it's funny how every time I go there, nobody like is even like interested, and then I see these analytics, and it's Californians who are the most interested in this. It's kind of like, you ever have this happen to you, where like you have social media, and I know I think this happens with Instagram, where you can see the people who watch your like feeds and stuff, and you see those same people in real life and they act like they don't know you, but then the ones who watch your feeds the most. You ever have that happen? And it's been a while since I've used Instagram, but it's maybe that's happening right now, where it's like I go back to California and like I'm not interested in this, and then as soon as I leave, they're watching the YouTube videos. Okay, well, let's get into it. So, what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. Yeah, your line of credit is going to be your main tool to help you pay off debt. And what is a line of credit? All it is a financial tool where you can borrow money, pay back, and use it over and over again, right? Use it over and over again. And the most well known line of credit is a credit card, right? Because it is the most heavily marketed line of credit. People are not as familiar with home equity or personal lines of credit or business lines of credit compared to a credit card, right? So you want to get as all of them as much as possible before you ever need them. And because here's the thing, banks don't lend money to people who need them, right? And a lot of people don't know that, or they don't understand that concept. So I'm always seeing new people on the channel writing comments, how do I get this? What's a step-by-step plan to get a line of credit? And I'm going to tell you the step-by-step plan, at least for me, maybe not for you, is you get it before you need it. Okay, you get it before you need it, because banks don't lend money to people who need credit. They don't, right? All right. And did I mention this? I have over $279,000 lines of credit. 279. It'll probably be 500 soon. We'll see. Once I'll give you an update once we get there. Okay. So in order to velocity banking, there's two things that we need. Number one is a budget. So we have a budget right here of someone makes good money, but we got this itty bitty savings, this $300 of savings. So that ain't looking too good. We got 5 credit cards. We got an all-in mortgage, and the whole purpose of it is think of this as a debt attack plan, right? The more debt that we pay off, the more debt that we pay off, the more cash flow we get, and that's the name of the game, is to increase our cash flow. And we're going to do that on day one, okay? So we have our budget. We have listed all of our debts. We need a line of credit as our main operating account. That's step two. And we have to understand that two things: we make the same income and we don't have any savings, right? Because velocity banking is just a way, is a simple and easy way to help us pay off all of our debt, or pay off our debt using all of our income. And the only way we can do that is pretty much having no savings. And we're going to use the help of a line of credit to do that. Because why do people have savings? It's because they need in case of emergencies. They're, like they wouldn't put all their money in debt or in a loan, because once they do that, what if they need that money, right? What if they need it? That's why most people will never overpay do extra payments on a mortgage, because if it were true, it's the default method of how you can easily pay off that mortgage early, but most people won't do it, right? Because they lose that liquidity. So we need to find another way to do that, okay? And also, what we're going to do is maximize something called cash flow, okay? So cash flow. So let's go ahead and do this right here. And all cash flow is income minus expenses, right? So this savings number and this cash flow number look exactly the same in the beginning, but here's the thing. We haven't finished setting up Velocity Banking because we need to make our line of credit as our main operating account. Okay, so let's just assume we have something called a home equity line of credit available to us in a form of a $100,000 line, $100,000 limit at 9%, right? So what's a home equity line of credit? Think of it as a big credit card based on the value of your home minus your debts. Okay, if you have enough something called equity, they'll lend it back to you just as long as you got the good credit and the financials to back it. Okay, so let's go ahead and assume we have a $100,000 line of credit available, and then this is what we're going to do. We're going to do a simple debt transfer and make our line of credit as our main operating account. So we got these 5 credit cards here, okay? And if we sum up the amount of these credit cards, let's go do this: 7 plus 10 plus 35 plus 12 plus 18. That's $82,000 of credit card debt. I think a lot of people would be freaking out about that. 82,000. Okay. So now, just by doing a simple debt transfer, guess what? This goes to zero, this goes to zero, this goes to zero, 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 right? So now we went from $300 or $360 to $2,885 a month. Okay? See how we increased this number on day one without really making more money? And that's really the name of the game, increasing cash flow. So the actual strategy itself is you put your entire paycheck into that line of credit, expenses out, and after every single month, the balance goes down by $2,885, about, right? Plus some interest. Okay. And when you put your entire paycheck, it does two things. It satisfies the minimum monthly payment, because the minimum payment is usually going to be like 2% of the balance, right? So that minimum payment don't even matter anymore. And you're going to minimize the interest because the interest is calculated by the average daily balance. Okay. And when you put your entire paycheck, guess what? The balance is going to be at its lowest, so you're going to minimize the interest. Okay. So let's go ahead and do that. So we're going to calculate the next month. And then next month's balance is the previous month's balance plus the previous month's interest minus this cash flow number, which is 2885.73. And then we're going to calculate the interest right here. So let's go ahead and do that. So what we're going to do is take this average function right here and get the average daily balance, right? Get the average daily balance. And the average is just going to be, this average function is going to be an estimate of the average daily balance. And then we're going to multiply it by this 9% number, so 0.09, and then divide it by 12, right? 9% is an annual figure. We want the monthly figure, which is why we divide by 12, okay? And so now let's go ahead and do that. And then guess what? All we got to do is just copy and paste, right? Copy and paste. And we see our debt being paid down with the power of our paycheck, our full paycheck. And we got to make sure we got zero savings. All right, so let's go ahead and do that. And let's see how long it takes for us to pay off this debt. And all right, so it takes us about 32 months, right? So 32 months is the payoff of those credit cards. And what's 32 divided by 12? That's about 2.6 years. Not bad. Okay, so 82,000 in 2.6 years, right? So let's go ahead and do that. So 82,000 and 2.6 years, we got that. And now we got to pay off our loan, or our what we have left, which is auto loan and a mortgage. And so let's go here and figure out, after 2.6 years, and actually let me go back here. How many months was it? 32 months. what's the balance of this auto loan? Okay, what's the balance of this auto loan at 32 months? So we got to put all these figures here. So 5 year, and let me go back here, 5%. Okay, and after 32 months, what's the amortization? 32 months, 10 grand. Okay, 10 grand. All right. So now, I just want to do a quick calculation. So 10,0950.7 divided by 415.17. All right. So next step is let's move this 10 grand into the line of credit, and we're going to have our cash flow increase by $415. Okay. So let's go ahead and do that. I'm going to move this 10 grand in here, and then we're going to move it right here. Okay. And by simply transferring this debt, and again, there's a little bit more nuance to it than just, hey, saying, hey, put all of your loan into a line of credit. I would definitely not recommend that. We want to study why we would do that. We're going to increase our cash flow. Okay. Let's go back here. And this is going to be 0. Okay. So now, what's our cash flow right now? It's $3,300.09. 3,000. Remember this because sometimes I go back and forth and I can't remember what the number is, and I always have to. I'm all over the place, but it's $3,300.90. So now, 3300.9. Okay. All right. And so now we've paid off the auto loan in the income, or all of our debts, including our auto loan, in 36 months, right? So now what we do is we add the 82 plus 22. So 82 plus 22, that's 104K in how many months? 36 months. So that's 3 years. Whoa. All right. So now what we're going to do is we're going to focus on the mortgage. Okay. So here's the thing about the mortgage, right? You can do 2 ways of paying off the mortgage early. One is by making direct extra payments. So you have your monthly mortgage payment of $1,199, right? And then what you can do is put this entire $3,300 that you have, which essentially would be in your checking or savings account, and directly over the pay the loan. Why are people afraid to do that? Well, the reason people are afraid to do that is because they need to have savings. That's the idea here. And one of the reasons why people don't want to wipe out their savings is because, let's say we pay their $3,300 into that mortgage on top of the monthly payment. What if we need that money back? We're scared to do that, right? Which is why typically when a refinance letter comes in, people will do it because, like, lower monthly payment. Even though they might be paying more. Again, it depends on the numbers, and they might do something stupid like doing a cash out refinance without any plan to use that money to generate more wealth. Okay, so let me go back here. So one of the way, as an alternative of directly paying into the mortgage, we could just simply transfer, again, do the same thing with the line of credit, paycheck into line of credit, expenses out, and then use our cash flow to pay down the line of credit. And so if, for example, like, actually, let me go back here and figure out what the balance of the loan is, mortgage, after 3 years. So let me go back here. So 200,000, 30 years at 6%. Okay. And after 3 years, look, we paid 11,000 interest, 2,000 principal, 11,000 interest, 2,000 principal, 11,000 interest, 2,000 principal. So the balance is going to be 192K. Ooh, excuse me. 192K. And let's just do this, okay? How long do you think it's going to take to go from 192K to 182K according to the mortgage amortization schedule? Again, most people will never overpay this because of the one-way nature of the loan, right? But let's take a look at this. It'll take us 1, 2, 3 years to go from 192 to 182, right? Why don't we transfer just 10K of the mortgage into the line of credit and then pay it off, right? So plus 10,000, and how long is it going to take us to pay that off? 1, 2, 3 months. Something that was going to take us, 3 years. Let me go back here. 3 years. 1, 2, 3 years is going to take us 3 months. And that's the whole idea of using your line of credit to kind of pay off your mortgage. Again, there's different ways you can tackle this, but one of the things I probably would not do is replace my mortgage with the line of credit, especially if you have a 6% or lower interest rate versus a higher interest rate line of credit. If I had a $300,000 line of credit, I would not replace my mortgage. As a general rule of thumb, I would not replace my mortgage to line of credit. You might hear that on the internet. I've never agreed with that. To me, that doesn't make sense. Again, and here's a cool thing: we have this Velocity Banking Calculator right here that can run a simulation. And again, this is provided to me by a company called Renatus. This is where I originally learned Velocity Banking from in 2017. And full disclosure, I actually make commissions off of selling their education. So they call us independent contractor marketer. But what I'm saying is that we have this cool calculator that will determine what the payoff is and how much interest you would pay and potentially save. Okay. So let's go ahead and put this here. So $200,000 original loan. And what's the current balance? It's 192, 168.14. 192, 168.14. Okay, interest rate is 6%, 30 years, and the payoff or payment amount is 1199.1. 1199.1. And we'll say 9% line of credit. And what is our income? Our income is $7,000. And our expenses is just our general one because we've already taken into account the mortgage payment right here, $1,200. All right, so the living expenses is $2,500. So we're just put $2,500 here. And I want to just show you two scenarios. So something that you might have heard on the internet is, okay, you definitely want a first lien HELOC. And then so let's go ahead and replace our first lien HELOC with a 9%, or I'm sorry, a mortgage, a 6% mortgage to the first lien, 9% HELOC. Okay, so let's take a look at this. And as you can see right here, the results look really impressive. 4.3 years at 40,000. Okay, you might say, wow, that's really good. But here's the thing: if we just move parts of the principal, they call it chunking, to that line of credit at a small amount, so let's say $7,000 equal to our paycheck. Look how that is so much more less. So we went 40 to 25, okay, by doing in little pieces or amounts, right? And so again, I've run many of these simulations, and if you have a substantial difference in the interest rate between the line of credit and the mortgage loan, I've never seen an example where you actually come out, you're better off than just doing the chunking method, right? And so right here, let's say I do this with a 30% credit card, you notice how I still pay less than a 10 or 9% line of credit if I replace my mortgage. So 192, 168.14, right? Is that crazy? If I use a 30% credit card, I'll actually come out on top by using the chunking method, right? By moving, small pieces of that loan to the line of credit. Okay? So let's go ahead and do that, and you can see we'll pay it off in about 4 years. $25,000 in interest, good times, and this is going to be zero, and then so 304K of debt in 7 years. Woohoo! 7 years. That's crazy. So we're not mortgage free in 7 years. We're everything free. All the credit cards, all the auto loan, all the mortgage, everything in 7 years, and not just the mortgage, right? So it's crazy. Again, you'll probably be debt free, but your friends will be drowning in debt. And maybe they had the opportunity to learn this, but maybe because it came from you, they didn't want to learn it. I know that happens to me, right? So your friends will probably be drowning in debt, and you'll be debt free. Like, what do I do with all this freedom? Hopefully you don't want to go back into debt, because that's like being out of prison and then like going back to prison just because you're lonely, you got too much freedom. And again, that's a real phenomenon. I don't know if you knew that, right? Like sometimes people, when they're in prison and they're with their fellow prisoners and they experience that taste of freedom, kind of like that, what do you call it, that analogy of Plato's cave, they want to go back. I think that's the analogy of Plato's Cave. I might be wrong. All right. Well, that's it for today, everybody. Happy. It's actually Sunday today. Happy Sunday, and happy Velocity Banking. And maybe we need to create a holiday for this. Happy Velocity Banking Day. I wonder what day that would be. Whatever day you get debt free, right? All right. Well, have a great day, everybody, and we will speak next time.